All right, let's start off with your reaction to this deal with Japan, lowering tariffs down to 15%, basically cutting them in half, and also seems to be kind of spreading positive sentiment when it comes just the trade picture overall. How are you viewing this?
Yeah, it's probably the meteor of some of the deals that were announced, given the commitment by Japan to invest. I think it's about a half $500 billion. Not a lot of details there. These are more frameworks than anything else. But as we approach the what we assume is a new deadline of August 1st, if we start at least inking, however you define a deal, it does take some of that uncertainty out of the mix.
I want to talk to you about the potential market ramifications, at least. We've seen some signs the yen's going to strengthen on the back of this, and maybe Japan becomes a more attractive market, not only for domestic investors, but also potentially for U.S. investors. Do you think this is potentially, at least, potentially a headwind for the U.S. markets hitting new highs?
I don't know about that. I think, we've had the view really for the past couple of years that international diversification makes a lot of sense. It's been a really tough sell when we had a multi-year period of time of U.S. exceptionalism, the U.S. outperforming, and now you've had this pretty handy outperformance over the past year or so with fits and starts of international. Our bias has been toward developed international, inclusive of Japan, versus emerging markets, which still have some inherent risks. So we do think that this is an opportunity, not necessarily that non-U.S. is going to consistently outperform U.S., but that you actually accrue some benefits to that global diversification play relative to years past where it was, nothing but U.S.
Okay. Your word of the day is sanguine. Who's sanguine? Are the investors sanguine? I mean, what's going on?
I think investors are fairly
Yeah.
sanguine. I think there's complacency that is built in. Maybe not the opposite extreme of what we saw on the intraday low on April 9th, when you had the opposite, incredible despair and the market was way oversold and breadth had been washed out. But I think given relatively muted volatility index and anecdotal indications of sentiment, maybe by retail traders with the rise of the meme stocks again and retail favorites and non-profitable tech. So you've seen this move a little bit down the quality spectrum in terms of what's been working, particularly recently. And that does suggest that there's some complacency in and of itself. That doesn't mean you get a contrarian move on the downside. It just establishes maybe a little bit more risk to the extent you get some sort of negative catalyst.
Also, want to get your take on the action that we saw yesterday. I'm going to play a soundbite from our Jim Cramer with his, belief of what was going on in the market yesterday.
The traders are looking at interest rates, imagining that there's going to be a recession. So they're buying up what typically does well in a recession and ringing the register on everything else.
So, listen, you agree with that take that was the action yesterday, and also that bond traders and I guess regular other investors are looking at the possibility of a recession right now?
So it's hard to gauge the possibility of recession, given that we are still dealing with a lot of instability with regard to trade policy, and the on again, off again suggests that the impact on the economy is going to be spread out over a longer period of time than I think was thought to be the case on April 2nd. April 2nd and the immediate aftermath of that, I'd say most economists up their recession odds to well more than even, and those have obviously been ratcheted down. I don't think you write off recession. I still think that we need to be mindful of it, particularly if the labor market starts to crack more than it already is. I think the bond market is telling kind of story about the economy.